Welcome back. You're still tuned into Halftime Report. Let's talk about retail sector. A recent Bernstein report suggests Trent's store network over-densification seems a key reason for sales growth drop. They add that company's revenue growth now is at the bottom. We are now joined by Jignanshu Gaur, who's the director and senior research analyst at Bernstein. Jignanshu, good afternoon. Thank you so much for joining in. Well, what makes you think that growth is at the bottom for Trent from here on? What are the factors that are indicating that this would be the case?
Thank you so much for having me. It's always a pleasure. We look at 4 reasons why we believe Trent's revenue growth has disappointed over the last 6-7 quarters, and it has fallen from the highs of 50% to close to 16% in the last quarter. And we believe those four factors are sort of at their peak right now. Factor number 1 being the densification of stores. They added a lot of stores, all back-ended towards fourth quarter of last year. Many of them were in the same pin codes where they had existing Zudio stores, and most of them rather, in the same cities where they had Zudio stores. So this impacted existing stores plus reduced the runway for ramp up of new stores, and hence has been a key contributing factor to their revenue growth disappointing, coupled with an element of broader urban consumption slowdown, because we believe most other players who are focused on metro and tier 1 cities have also grown slower than some of the players who are focused on tier 3, tier 4 cities, where the consumption slowdown seems to be relatively better than here. We think both of those large key points are at a peak today. So going forward, the base scenario, the base impact plus the underlying scenario for Trent should be better than what it is today. And hence we pencil in a slight improvement in growth in H2 versus H1. However, we are still under consensus numbers for Trent, but we believe the price indicates even a scenario which is worse than our numbers, which is why we remain constructive on the name broadly.
Jignanshu, if in case you are penciling in the second half growth, can you just tell us what they did in the first half? How much are you expecting in terms of growth in the second half, as well as what the margin performance will be based on what you're expecting, say, when it comes to competition, as well as the densification that you spoke about?
Sure. See, first half growth was approximately 17% YOY for them, 19% and 16% in quarter 2. We pencil in a full year growth of 19%, which means the second half number should be around 21 odd percent. Festive is a better season for them, so that will help. And then the base effect of last year, where a lot of these stores came into Q3 and Q4, should support the growth as well. So if we pencil in 20-21% growth for H2 of this year. Margin wise, we expect the margin to remain stable. Trent has improved its margin significantly over the last 6 quarters, despite revenue growth rate falling. We believe many of these changes, or rather most of these changes, are structural in nature, led by improvement in employee cost as a percentage of revenue by deployment of technology, as well as other expenses as percentage of revenue. And hence we expect the margin to remain largely stable. We forecast a 14% EBITDA margin for the company for this year, which will be 150 to 200 bips higher than what they did in last year.
Okay,
so better margins, but stable.
Okay, stable margins, but growth bottoming out from these levels. So decent outlook on Trent from here on. Jignanshu, that's about a specific stock, that's Trent. Let's talk about Swiggy as well now. The fundraise, that's a huge one, 10,000 crore rupees. What do you make of it? Do you think the company needs that amount of money for growth purposes? What's your take on this entire exercise?
We believe that the quick commerce space is going through significant competitive intensity again. This was the similar scenario in Q2 and Q3 of last year, and the same scenario today. We don't expect 2026 intensity to be lower in any scenario. If you want to be one of the top 2 or 3 players in the market, companies are going to need growth capital. And while food delivery is a net cash flow positive business for Swiggy, as it is for Eternal. We do believe they will need capital to invest, both in terms of capex, but more importantly, in terms of loss funding.
So it'll
And
be
that
for
is the
existing verticals for them, or do you think it'll be used for newer verticals? Just trying to understand, because their growth in, say, quick commerce or food delivery has been decent. So do you think it'll be done to accelerate growth there, or look at new avenues?
I would expect a large part of this, at least over the next 12 months, would be for solving the quick commerce business. When I say solving, they need to solve for two things. For the current dark stores, they need to solve for profitability, and they need to bring growth back in terms of their dark store network, which has sort of fallen materially over the last 2 quarters. And that has been a concept, a proper strategy by them, because they had to balance profitability and cash. So we think it will be largely for quick commerce business. That is what I believe they should be solving for.
Okay. The new labor laws, what is the impact according to you on e-commerce companies?
See, it's still very unclear on what exactly rules the labor laws will take. Even the code which came out mentions a very wide range of 1 to 2% of revenue, and that's like 100% difference. But if we take some broad assumptions, we expect the impact to be 2 to 3 rupees per order, which is material if you assume that they will not be able to diffuse this cost in two big ways. One way is they already spend a lot of money on health, accident, maternity, etc. insurances for their existing gig economy workers, so that they can offset once they start giving this money to a common government controlled fund. Second, whatever is remaining impact can possibly be passed on to either some of the ecosystem players or eventually the customer. Will this impact demand? It might. There is always some demand elasticity, but we don't expect a material derating of the companies in any shape or form because of this.
Okay, all right. Well, we're going to let you go on that note. Thanks very much for joining in and speaking with us about the consumer space. So Bernstein talking about stocks specifically, such as Trent, where they have a target price of around 5,000 odd rupees. They are expecting a pickup in the second half, and they don't see much of an impact on the change in labor laws on e-commerce companies in the long term. We'll take a short break with the news that the markets are weak, so good time to get a technical check. We have Pritesh Mehta of Yes Securities joining in next. Stay tuned.